And we are officially live, broadcasting only on onedealaway.com/live. My name is Nev. This is Money Matters, and today is Friday. Happy Friday to you. I can't believe it's Friday already. Actually, can't believe that November is a week from now. How crazy is that? But of course, before November, it's going to be Halloween and then Dia de los Muertos, and then we roll into, well, voting, right? Then we're gonna go into that craziness, followed by hopefully some grace and peace with Thanksgiving and December. But we'll see. We'll see. There's still so much stuff that can happen between now and then. And today, what we're going to be talking about is real estate. Now, typically, we do a real estate show on Thursdays, but there were some crazy things happening with crypto yesterday, with Bitcoin pumping like crazy, that I felt it was irresponsible of me not to talk about it and address it, since real estate is kind of slow moving and Bitcoin could be fast moving at times. Sometimes it's kind of slow, but often it can be fast. So I thought that we would do this and just kind of flip it. So today we're going to be talking about real estate, what's going on, what is the interest rate, what are the mortgages, what's happening with the numbers, what are the prices, and I'm going to be sharing with you some of the cool places that you can go and find stuff and research, because I spent a little bit of time geeking out this week, and I will explain exactly why and how I did that, and why in the world would somebody decide to go through the pain that I did. So I'll explain that in the show. If you're a curious kind of person, hey, you are definitely here for a good reason, so welcome. If you're watching this live on onedealaway.com/live, please do subscribe, say hello, and we're going to do Q&A at the end of the show as always, and of course, welcome. If you're watching this elsewhere, like YouTube, for example, or maybe Facebook or somewhere else, well, do me a huge favor. If there is some sort of subscribe button, smash it. If there's some sort of I'm enjoying this content, show me some support, show me some love. I would really appreciate it. And of course, if there's a way to turn on some type of notification so you get notified every single time when a video goes live, which is, well, basically just about every single day, then hit that too, set it all up, and then that way you get notified of things as they are coming your way. All right, y'all, let's do this. All right. Good morning. Welcome. I'm just going to make this thing over here a little bit smaller because I have I'm trying to do two screens, and if you know anything about me, good luck with that, because I can't focus on two things at once, nor would I want to. Okay, well, look at this. We are already here, and we're going to be talking about what is going on. Look at this. The new mortgage rate hits a brand new low. Now, one thing, the reason I have actually highlighted the date is because, well, today is October 23rd, so this is like as of yesterday, and so that's why I thought it was important to highlight it. But B, because the very next article that we're going to take a look at is also showing a little bit different information here. So I wanted to make sure that I pointed that out, that I'm not quite sure exactly what's going on, because we're getting a little bit of a conflicting information, but one of the key things to remember, oh, I don't know, why did I disappear? Where did I go? What happened, Nev? I don't know. But one of the things that I think really matters to talk about and to share with you is that, we can talk about these rates and what they're supposed to look like and what the average is, and at the end of the day, like, while that's nice to know, it's completely irrelevant to you, because average could be 3% if you have a good down payment and you have a person or people that you have been working with, and you have you get a rate. You could actually get a rate as low as like 2 point something, right? And it could be in that like two lows, or low twos. There we go. I was like, wait a minute, that didn't sound right. Low twos, right? So you could be like 2.1, 2.5, 3.3. I don't know, right? And then you could also, there could be another person that, credit maybe is a little bit more shaky. There might be some stuff that is happening over there, and their rate could be 3.3, right? We just don't know. So when we look at this stuff, please don't expect that yours is going to be that, because that's not how it works. I think you already know that, but I would be amiss if I didn't mention it. So here we go. Average rate on the 30-year benchmark loan edged down to 2.8 from 2.81 last week. By contrast, the rate averaged 3.75 a year ago. 15-year rate mortgage declined to 2.33 from 2.35, and this is coming from Associated Press, are the rates over here. Now, you will also notice that I'm going to come over here and we're going to talk about this particular article, because it's talking about and discussing how mortgage demand for home builders is falling for for 4 weeks now. Now we've been talking about that and discussing it here on the channel, that we're seeing a little bit of slowdown, and I've been saying that, expect for this to happen. Like, everybody that kind of wanted and decided and could qualify pretty much did it. I mean, yes, it's still happening, but it is slowing down. And as we get into November, as we get into December, it is going to slow down. Simply, once we hit that like Thanksgiving and start getting into the winter holiday season, forget it, man. Like, nobody's working. But that doesn't mean you can't close deals, right? That doesn't mean you can't finish stuff. That doesn't even mean that you can't start things. It's just that most people don't. Now, for me personally, that's my favorite time to go, because there's not as much happening. That means there's not as much competition, which means I can typically, not always, but typically get some of the best deals. Mortgages, purchase prices, rates, and I can go in and do it much, much faster. Again, it doesn't always work out that way, right? It doesn't always play out that way, but it is a possibility. So something for you to think about. Now, this one is also October 21, 2020, right? And the reason I highlighted, because remember how we talked about one rate versus the other? So let's read, let's learn, and I'm going to show you something completely different to bring back my point of, it doesn't really matter what they say, it matters what happens to you. Home buyer demand is incredibly strong. Total mortgage application volume fell 0.6% last week compared to the previous week. Application to purchase a home fell 2% for the week, which is the fourth straight week of declines. Purchase demand is down nearly 7% compared to 4 weeks ago, or let's put it a month ago, which again makes a bit of sense. So you want to kind of keep that in mind, and you also want to acknowledge that sometimes things kind of like start falling in place. Folks might be outpriced from the homes. They have found what they're looking for, and so it just kind of makes sense to it. But here's some of the things that are also happening. Demand is outstripping a new supply coming onto the market. So that's part of the challenge as well, that even there are still folks who might be looking and stuff, but you go in, it's like you turn around and it's sold and it's sold and it's sold, and you're like, what is going on? What is going on? I can't keep up. And I will tell you, I see it here. I go for walks all the time, and I see it here. And it's like, the price will go up for sale. I'm like, oh, cool. When I get home, I'll look it up, because I'm just curious, right? I'll look it up and stuff, and then I might forget and stuff. And then 2-3 days later, it's like pending. And then 2-3 days later, sold. And I'm like, whoa, what is going on? So they really are going like hotcakes, even around here. I don't know what is happening in your neck of the woods. So please let me know in the chat or in the comments, because I'm very, very curious. But here where I am in New England, homes are going like hotcakes. I can tell you that much. Rates did move slightly higher last week, and they're saying 30-year fixed rate increased from 3.02 to 3.02 from 3. So we have here an article that says that the rate is 2.8%. This one says it's 3.2%, right? Or sorry, 3.02%. But then as I was looking at the stuff, I didn't have this one. It's like, oh, look, apply with us. Today's mortgage rates all-time low is 2.17 APR. So I'm just saying. I'm just saying. So you can, do your own research, do your own due diligence, find out of what actually is true for you if you are so inclined. But I think these are always good to kind of take a look at and get an overall pulse of the market. So overall pulse of the market is that the rates are basically steady. Rates are basically steady. They might go slightly down, slightly up, but we're still seeing it. High twos, low threes. Just keep that in mind, right? That's a pretty good idea. And again, there might be folks who can get it in low twos, and there are folks that might need to pay mid or even high threes to get in. Just don't know because it is a very individualized component. Now, another piece that I wanted to mention before we kind of continue over here is that a lot of folks have been talking about this magical real estate crash in 2021. I don't expect that it's going to happen. I do expect that this sort of buying stuff may go into 2021, early 2021. Whatever ends up happening, obviously, none of us have a crystal ball. Yes, I am concerned about the unemployment numbers. Yes, I'm concerned about the fact that the stimulus is all but dried up and people are suffering a great deal. Yes, I am very concerned about the election craziness and who the hey knows what's going to happen with that and how people are going to behave, and then when they get into the office, who they're going to pick and what those people are going to do, right? So there's all of the crazy stuff. Now, if Trump goes in, more likely than not, he's probably going to do things that are beneficial for real estate owners, right? Just because he's an investor in real estate, and once an investor in something, you're an investor in it for life. Unless it bites you, which I don't think it has. So I don't see him changing direction on that stuff. Biden, I don't know. I don't know where he stands on it, where he truly stands for it, right? Because it's one thing what they say to get elected, and it's another thing of what they do once they are elected. Wouldn't we agree to that? So, anyways, that's kind of where I stand. So that's part of the stuff that is happening, and then I am concerned about the number of folks that are in this forbearance and inability to pay and stuff. Now, like I said, because the numbers are so huge, so large, I do believe that vast majority of the banks will work with individuals who are in this situation to restructure their loans, to get them into the lower rates, to extend their contract, to push whatever they owe towards the end of it and rework it on the stuff. We're seeing these iBuy companies and that kind of stuff, and a lot of large money, as they say, jumping into these components to kind of go in and save it. So I don't think we're going to see the crash that everybody's talking about predicting. And if it happens, it's not going to happen in 2021. I am firmly believing that. I mean, we are here at the tail end of October, right? It's October, 23rd today? It's a Friday, October 23rd, yeah. So real estate is slow moving, right? They're still lending, they're still buying, there's still these crazy sales, which means that if I am a strapped individual homeowner who's struggling, I could put my home up for sale and it's probably going to sell super, super fast, meaning I can get out of my hot mess. Hopefully, I'm not upside down, which means that I actually get some cash out of that deal. And now I have some cash where I can go in and rent or maybe buy something smaller that might make more sense or might be more affordable, right? And so I think things are going to work themselves out over time. There's always a risk that things are going to implode, right? But if that was to happen, right, in the last crash and stuff, like when things started to roll out, things started to roll out. We saw this slowdown begin in 2005, and the default rate started to go in the late 2005, but we didn't see a blow up until 2008. That's 3 years, y'all. 3 years. So if we're seeing we're not seeing default because they're going into forbearance, so they're actually working with folks. So that forbearance expires sometimes middle of 2021. So when we start seeing potentially increase there, we're starting to see a little bit of decline into the buying frenzy, but we're still up over a year. So I'm not as concerned about it. And again, it makes sense where we are seasonally. But then you get into the middle of 21. That's going to be an interesting time to watch to see what's happening with those defaults and where folks are. From there, right, for them to foreclose and to go over that, again, it's going to take anywhere from about a year, 6 months on the shortest end of the stick, to 1 to 3, maybe even 5 years for all of that to clear. So if it all begins in 21, basically, and let's say middle of 21, right? That basically means that the earliest some of the foreclosures and that kind of stuff that we could see potentially would be December 21 into January of 22. And that's only in a few key places where foreclosure is quick. Everywhere else, foreclosure is painfully slow. You got to go to the courts and all of this crazy stuff. So then we're looking into 22, 23, 24. Now, does that mean that it's a great time to go into the get this frenzy? Maybe, maybe not. It depends what kind of frenzy you're getting yourself into and why. What is your exit strategy? If you need a place to live, sure. Should you be bidding on arm and a leg? I don't know. Maybe if you're homeless, and you have money, go for it, I guess. But otherwise, I don't know that it makes sense. And I am seeing some signs of bubble. But would I say that we are in a 2005, 6 kind of bubble, 7? Probably not, but I am seeing some signs of the bubble. I'll share that with you of some of the things that I'm seeing here. September existing home sales jumped 9.4%, but prices are rising too fast as supply remains tight. So we're seeing that folks are going in and existing homes are rising higher than expected, 9.4 in September. Sales could be more robust if there were more homes available. The inventory of homes for sale fell 19.2% annually to just 1.47 million homes for sale at the end of the September. At the current sale pace, that represents 2.7 months supply. Now, we've been talking about it here on the channel. Sorry, allergies. We've been talking about it here on the channel that typically you need about 6 months in a healthy market. And we've been seeing this dwindle down, go from 6 down to 4 point something, 3 point something. Now we're down to 2 point something, which basically means that in a couple of months, if things don't shift in a big way, we're going to fall under a 2 month supply, meaning that it's going to be really, really, really tough to buy homes, and those prices could get through the roof. Now, there are home builders out there and they're actually jumping in and building. The problem is we had this giant shutdown, meaning that there's a lot of delays coming with it. The second part of the challenge that is coming with and happening with the home builders is that the lumber prices are up. And they are really, really up. I'm not talking like a couple dollars up. I mean, I'm talking up. I can't remember exactly what the price is, but we were looking at like some plywood and stuff or an OSB. And before they would be about $26, $27. Now they're like 50 something, $60. So that's like double. That's double and more than double in the price. Well, that also means that the price of that home that is being built is going to have to be double because materials are costing that much. Now, large builders have already pre-bought, and so they typically have, stuff in their own storage, in their own sort of inventory, but so they can run off of the old price, especially if they have quoted a particular price. However, when they get out of that and then have to start buying new things, that is going to be highly problematic because that's when we're going to see these prices rise and rise in a very big way. Another piece that I also noticed that is like really, really crazy, not just lumber, PVC. So PVC piping, PVC siding, and PVC fascia and that kind of stuff, right, that you put on the outside. That's ridiculous. Like we just went I want to say about a year ago, plus minus. Please don't hold me to it, but yeah, about a year ago, because I was trying to get it done before winter, so it would be a year ago, almost to the date. Then, uh, I went in and bought some of the PVC fascia, whatever board thing, and I think it might me cost me like $50 for like a 12 footer. This year we went to buy it and it was like 170 something dollars for it. I'm like, wow, like that is crazy. So things are definitely getting way, 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 way more expensive in this particular industry. And so that's something to pay attention to as well. Tight supply continues to push prices higher. And what is actually happening is that the median price is actually going up, and we've been talking about the challenge with that stuff. And the chief economist at National Association of Realtors said home prices are simply rising too fast, and I absolutely agree with it. This is part of that sort of bubblicious sort of I have concerns about it that the prices are going up way too fast, way way too quickly, way too shortly, right? That sort of increase. If you were watching some of the previous shows, when we look and talk about the charts and that kind of stuff, we talk about more on that non real estate stuff like Bitcoin, for example. Um, we always talk about the chart and always talk about when it goes up, like straight up. I'm always concerned because it has to come down, right? But if it's a nice sort of chugga chugga, slow, boring, nobody's paying attention to it, I get excited then because the chance of it actually continuing to go up and staying steady is much more likely. So that's kind of where I feel about same way with the homes right now. Simply is the weakest at the supply is the weakest at the lowest end of the market, and that is where the prices are rising the fastest. And of course, prices are strongest at the higher end of the market. So what is happening is that the folks are getting priced out of homes, and so they're trying to go in, they're trying to jump in. It's so lovely that it actually highlights the highlighted. Um, so folks are actually getting priced out of the homes, and the affordability of the homes is really truly going actually away, which is causing some of the problems. And so then folks are starting to stretch themselves, are saying, no, 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 we really need a home, we really need a home, let us go and buy it. And so that's where some of the concerns that I have, that somebody have started and saying, well, we could afford a $300,000 home, for example, but now they're pushing themselves into 350, 400 because they couldn't find it and the prices kept going up. That is part of the concern that I have, because once they get into the home, it's not just getting into the home, it's what happens when you're in the home. The maintenance, the cost, the ongoing expenses, the unforeseen expenses that you couldn't even predict, and sometimes insurance is not even going to cover that because it's not like tree fell on your house, which actually I hope it never happens to you. But then the insurance kind of comes in and be like, all right, like let's pay for covering it up. Sometimes things just die and you don't have an insurance for that. Although you could have a home warranty, for example, from a seller. I don't know. I don't know if they do that still, because that was happening when it was impossible to sell stuff. They were offering home warranties. Now I don't think that they offer that stuff, right? Because you don't have to. You open a door, you say your house is for sale, within 10 days you walk away with cash. That is what's happening right now. That is a second sign of the bubble that I am having concern about. So I am concerned about that the prices are rising too fast. I am concerned about the fact that people are getting priced out of the markets, which means that they will often try to stretch things in, right? And then I am also concerned about the fact that they might not be able to afford getting into it. So that's kind of some of the bubblicious pieces. And then there is this particular component over here, and the way that they have actually laid it out. The chef got COVID, got laid off, and then became a home builder. I'm like, wait, what? Like, that's a sign of the bubble, right? That's a sign of the bubble, but it's not. It's not exactly as they have painted it. Basically, what the story is, that this gentleman actually here in a photo, got laid off. It was in a restaurant industry. Restaurant industry is suffering. Didn't know what to do. Had discovered and saw an advertisement for Colorado Home Builder Academy, which is a free nonprofit construction training program backed by Colorado based builder Oakwood Homes, a Berkshire Hathaway company. So he jumped in, he decided to go in, and they're saying that the home construction on the market is short about 57,000 workers. So he jumped in it and, got training and then got a job from it. So I'm like, okay, he didn't become a home builder himself. I mean, he did as far as like a job going out there, but he didn't get like, oh, well, I was a chef owning a restaurant. Now I'm just going to switch and now I own the home building company. And like, I don't know how much I trust you, but I'm cool with them going in and becoming an employees of that. So a little bit of a shift, but it was definitely these are the types of news coverage stuff that make me start thinking like, okay, we're starting to get a little bit on the crazy end of things. I mean, we started on the crazy end of things a few months back, I won't lie, when people started fighting and arguing over the things, but now it's definitely picking up. Now they're saying construction is a bright spot in the economy, and I think it is for now, but again, winter is coming, things slow down, you can't move as quickly. And of course, they were saying, well, when we were declared an essential job, people started to thinking long term and lives, and I think it makes sense. But I also think that it makes sense for you to think through and consider that everything is cyclical. So just because real estate is up in demand in the construction stuff, not everything is going to be that way for forever. And I think that that's an important aspect for all of us to think about and consider, right? So that's one piece that I wanted to share with you. And so there are definitely some concerns that I am watching. Does that mean that I am not necessarily excited about the marketplace? No, quite the opposite. I am. Still very much in it. I still believe that the whole, like, with rates being super low, it makes sense to refinance. Even if it's not a cash out refinance, even if you just don't increase the amount of money that refinance, because at the end of the day, like, it kind of makes sense, because here's the thing: if you can go out there and let's do my fancy schmancy drawing piece. I don't know why it shows up this way, but it does. If you have a house, oh, let's see. No, you don't want to play. Don't want to play. All right, it doesn't want to play. Never mind. Sorry about that. But if you have a house, for example, and we're gonna cover this in just a second. If you have a house and your mortgage is $250,000, for example, and you don't want to increase it, but your interest rate is 3.5% or 4.2% or 5%, or some people still have the 7% version of the whole thing. I'm not saying go crazy and like pull out all of the money and like use it as an ATM. What I am saying is, reconsider and think through potentially refinancing. Again, not a financial advice in any way, shape, or form. Whether you do it, whether you don't do it, again, lose nothing. But I always look at if there's a way for me to save some money, why wouldn't I? So if my mortgage remains the same, but my payments go from, say, $1,200 to $700. Well, that means I just saved myself $500 a month. Now, that $500 a month could help with my ongoing living expenses. If I don't need help with that, that money can go over towards the saving for capital investment or for paying off debt or whatever. Or if you don't have any of those, then I can still pay $1,200 towards paying off the mortgage if you're wanting to sort of pay it off faster. So what I'm saying is, just thinking logically through the process of the whole thing. A lot of times people think of like, oh, refinance only means that, I'm going to get more into the debt. Well, potentially not, right? Potentially you could still keep the same thing. You just literally refinance the amount without any cash back, without any increase in it, without any of that stuff, just to be able to actually lower your monthly expenses. And that, I think, is very, very important and key, especially now that we are in very much a deflationary environment. As much as I keep on hoping for inflation to come back and kick in, because it works really, really, really incredibly well for real estate investors, that's not where we are. were we going to get there? Yes, I think we're definitely going to get there. Is it going to be anytime soon? Probably not. I think more deflationary pain is coming before inflationary thing happens and shows up. So this over here is an article that I thought was really cool. It's called the 18-hour cities and what's going on, what the emerging trends are shaping the real estate in 2021. I'm like, all right, well, this is cool and interesting enough, and I can't make it any bigger. Sorry about that. So basically, they went out there, they interviewed about 1,600 real estate professionals, trying to get different feedback of what's going on. And they were basically talking about that, cost conscious companies will start gravitating towards cities that are business friendly, low cost, and with the growing workforce. And Raleigh, Durham, North Carolina is an example that they are using it as a place where it might see some growth, where the companies are going to go. And I think that a lot of companies will start moving around and shifting, looking for where is the business friendly environment and where is the easiest and less expensive cost of living. And only a few days ago, we did a show right here on the show. We talked about the fact that there's some proposals about the new tax plan where people are like freaking out because taxes, if they change, if they shift in certain cities, in certain states, could hit like above 60% on the income. That is absolutely insane and bonkers. And so people and companies are saying, I'm out. I'm out. I'm leaving. I can't do this. And of course, where they're going to go, if there are business owners that are going to go to the business friendly states, they're going to the zero tax states, right? To reduce that stuff. So Texas is seeing a huge increase. Florida is seeing a huge increase. And there's a lot of areas within those states that are seeing the increase. Now, the 18-hour cities, they're basically saying that they continue to dominate the overall top 10 real estate prospects and that kind of stuff, from affordability to building outlook to job prospects to growth to that kind of stuff. And the reason they're called 18-hour cities is because they're saying their downtowns are not just a 9 to 5 kind of thing. They actually have things happening on weekends and at night, and so it's a much more robust kind of place. So that's, I guess, where the name came from, or at least that's what they said in an article. I am not an expert on that one whatsoever. So here are some of the places that are 18-hour cities. So Raleigh, Durham is one of them, right? North Carolina, Austin, Texas, Nashville, Tennessee, Dallas, Fort Worth, Charlotte, North Carolina, Tampa, St. Petersburg, Florida are just some of the examples of the 18-hour cities, so-called because they tend to have downtown that flourish outside the 9 to 5 workday. See, I didn't make it up. Came exactly from here. So this is an interesting piece. Now, they were talking about the millennials, and they are moving and they're wanting to go into the suburbs because of the families, but they also like the downtowns. So they're saying that there's a high potential that we might see that downtowns of the larger cities are going to start shifting to appear much more like suburbs. Now, I don't know how you do that necessarily in a town, right? Because, the reason we go into the suburbs is because there's peace and quiet, there's space, and so, I don't know how you do that in a city per se. But they're basically saying that they're looking for creating parks and that kind of stuff. So here's a quote of what they're saying. Cities will most likely look for creative ways to create a type of amenities that people search for in the suburbs. Cities have been very aware excuse me, that open space and parks are essential to a good quality of life. We think that it's going to become even more so. Social unrest and protests in cities across the country have also played a role in the reevaluation of where folks live. Now, before we continue, I do want to share right here something that I have already shared. I've shared it with you in one of the videos months and months and months ago when the whole, pandemic hot mess thing started, where I was saying that, people used to move to towns because of jobs, right? You relocated because of job. Well, as jobs became remote and you can work from your home or wherever you want, whatever your home is, people are going to start moving where they really want to live, not because they have to be there to be close to work, right? So then the commute became a non big deal, right? Like before, you were like, man, I am not commuting 2 hours or 3 hours or whatever, one way every single day, Monday through Friday or Monday through Saturday, sometimes even, right? So you're like, forget it, I'm not doing it. But when you're remote, you were like, I don't care. And even if they need me, once or twice a month, like that's not a big deal. Like we'll make a road trip out of it. I'll drive for a day for, whatever. So people are starting to move. We're seeing reports where folks are actually getting into very, very rural areas because they really want to escape it. Now, so that's one piece that is happening right now. The second part that I think we also cannot, that people are not talking about, but I think it's very important and we cannot not talk about it. And that has to do with vehicle transportation technology development. There is also development that is happening in that regard. So not only are our homes becoming smarter, not only are we working remotely, not only are we meeting just like you and I right now, right? But we are also then getting cars that can go further, that are autonomous. And as that becomes the thing, right, of more autonomous cars, more autonomous roadways that are likely going to be built. I know it sounds crazy right now, but just think through it with me. When they said electric car is going to travel from coast to coast and stuff, you probably thought it was crazy. When you said that there's an autonomous vehicle that can drive itself, you just have to sit behind the wheel, read the paper, I guess. We thought that was crazy. When we said that there's going to be like a vehicle without plugging into filling in with gas, but you just plug it in, we thought it was crazy, but we do have Tesla doing that. We have other companies that are starting to go out there and create and do that stuff, right? So it is happening. It is possible, right? And so that potentially means that when we start seeing some of that stuff, then we start seeing an infrastructure around that development of the new tech happen. So is it likely that we're going to start seeing roads that are specially built for this stuff, or lanes specially built for these vehicles? High-speed rails are all the rage in, well, most of the world except the United States. For some reason, U.S. is against infrastructure building. I very sad, but true. That's just kind of how I feel about it. But, if we were to build something like that, well, that makes it even easier, because now I can go from, my house in middle of nowhere, Maine or New Hampshire, to Boston in, I don't know, 40 minutes, 30 minutes, right? So I just get my cup of coffee, I watch my favorite show, like Money Matters, and I go to work. Only a few days a month that I have to. So I think we're going to see more of that sort of develop and expand and be created, and kind of that's going to shift a lot of the city living. And so I think we're going to start moving away from that stuff. So I don't, do I think that cities are going to die? Probably not. But what I'm saying is, folks are going to kind of move away from the stuff. And now with the drones and everything else delivering things to you, bring it on, man. Bring it on. And now if I can live in a small town where I actually really like folks, right? Hex yes. Hex yes. And, with this virtual reality thing developing, where we can go in and put some sort of thing, and eventually it might not even be a thing that we put on, but we go into these augmented reality and virtual reality worlds. That means I can go and hang out with everybody from a world, even today, go watch concerts, sports venues, all of that stuff. And that is coming. Well, it's not that it's coming. That's here. That is already here right now. That is already here. And that generation, that area is exploding. And when those folks continue to age, which they will, and they continue to grow, that is how they're going to interact. And guess what? Us old farts, if we want to continue to work with them, we're going to have to get used to it, right? We're going to have to go into it. And that is how meetings are going to happen. They're not going to be Zoom forever. They're not going to be this forever. We're going to go into some sort of virtual reality office where I'm going to be able to high five you in 3D, in virtual reality, sit in the office, go attend the stuff, maybe even work from my office if I wanted to, and really create it. And I know that sounds crazy, and to some of us that are old farts, uh, scary potentially, right? But that is the reality of what is coming in the future. And so all of that is going to shape and shift real estate stuff. All right. Social issues in real estate, income and racial inequality moved from little to moderate importance last year to moderate to great importance this year. So, of course, we still have a lot of social issues, especially, not just income and racial inequality, which of course is impacted, but where the problem is, it's in affordability of the homes, right? So if a person is not making as good of an income, that means that they also cannot afford to buy homes. If they can't afford to buy homes, especially in certain areas, right, that's when it starts creating this inequality, right? And so that's something that honestly I believe it's been all created by the Fed, and it's just my personal feel, because they give money to their friends who have friends who give them money, and so by the time you're like the trickle down that they keep saying that is happening, that nobody's like, I'm still waiting for the trickle. It's been years, no trickle here. So I don't, anyways, that's just kind of how I feel about. But I think it is an important concept, and the challenge with also we've been talking about here, even on this channel, is that you do have folks that are, building homes. Well, they can't build affordable homes because there's no money in it. They have to pay the for the permits. They have to pay for the staff. They have to pay for that land. They have to pay for all of the supplies and the lumber and everything else. Well, all of that adds up, and so the margin is super super thin, and the margin of error is like null for them to be able to be successful with it. So of course, it's much easier for them to say, I'm just gonna go and put in 10,000 more, but at least I can then charge 150,000 more. And so for them, it makes sense. So that's another reason why we're seeing some of this sort of discrepancy, because what's being built is not being built for the affordable housing. Real estate taxes, generally the largest source of the local government revenue, are likely to decline as hotels and shopping centers and potentially offices lose tenant and value. And what I think is also going to happen is that some of the areas, not all of the areas, I mean, I think all of the areas are going to see an increase in it, but some of the areas are going to go bananas, not so, with the real estate taxes. And so that's something to watch out for and pay attention to. And what they're saying is that the next few years promise to be retail's great transition period, and it's going to be a very interesting thing to watch. Much smaller physical retail presence and vast amount of vacant space with lower rents. So that's something that we can expect. 65% of the cities will delay or cancel infrastructure projects. Shocker. I mean, they haven't been doing infrastructure projects even when they could. And now that they're broke, how are they going to do it? Times of great change always present significant opportunities, and I absolutely agree with that. And that is how I am going to end this show. Thank you so much for watching. Do hit the like button, subscribe, and I will see you tomorrow. Until then, stay forever money blessed, and do remember, you are only one deal away.